For decades, Japan's ultra-low interest rates established the yen as a preferred funding currency, quietly supporting a wide range of global financial transactions. This access to inexpensive yen enabled global investment and speculation as investors borrowed at low cost to pursue higher returns in other markets. Now, the Bank of Japan is adjusting its approach, moving away from negative interest rates for the first time in years. This represents a significant change in monetary policy. This volume signals the conclusion of a period when investors could borrow yen at minimal cost and invest elsewhere for higher yields, a strategy known as the yen carry trade, which has influenced global markets for many years. The Bank of Japan's decision, influenced by rising domestic inflation and a goal to normalize policy, is prompting investors to reassess risk and return and to reconsider their strategies. The effects are broad, impacting financial centers from Wall Street to emerging markets as the cost of capital increases and financial flows adjust. Investors, corporations, and governments that previously relied on low-cost yen are now adapting to new conditions, reviewing their portfolios, and managing potential volatility. Attention in global finance is shifting from Washington to Tokyo as Japan's economy becomes increasingly influential in shaping global monetary policy. Decisions by Japanese policymakers in the coming months may influence global economic conditions, affecting currency values and international trade. The financial landscape is undergoing a gradual transition, with changes unfolding across markets. The stability of global markets will depend on how this transition is managed, as both uncertainty and new opportunities emerge. The period of Japan as a primary source of global capital is drawing to a close, concluding a chapter that supported international growth for decades. Global capital flows are adjusting, and observers are monitoring to see how these changes will shape future financial dynamics. The yen carry trade is a straightforward financial strategy. Investors borrow Japanese yen at very low interest rates. Due to Japan's long-standing policy of keeping rates near zero, they then convert those borrowed yen into another currency, such as US dollars or euros, to seek investment opportunities abroad. With this new currency, they invest in higher-yielding assets overseas, such as foreign government bonds, stocks, or real estate, where returns are typically higher than those available in Japan. The potential profit comes from the difference between the low borrowing costs in Japan and the higher returns available elsewhere. This approach can be effective when market conditions are stable. For many years, this strategy was supported by Japan's near-zero interest rates and a relatively weak yen, making borrowing inexpensive and repayment manageable. However, there is a key risk: currency fluctuations. If the yen strengthens against other currencies, the cost of repaying those loans increases, which can reduce or eliminate profits. A stronger yen means that when investors convert their foreign assets back to yen to repay their loans, they receive fewer yen for each dollar or euro, making repayment more expensive. Recently, the Bank of Japan has begun raising interest rates for the first time in years. This reduces the gap between Japanese and foreign rates, making the carry trade less attractive and increasing its risks. If investors expect the yen to continue rising, they may choose to unwind their positions by selling foreign assets and buying back yen, which can influence market dynamics. This process can contribute to further increases in the yen's value and may lead to additional adjustments in global markets. The period of a consistently weak yen may be coming to an end, indicating a shift in global financial conditions. What was previously considered a relatively safe strategy, the yen carry trade, now involves greater uncertainty and risk. As a result, the global financial system is preparing for potential changes, with investors and institutions monitoring developments closely. After the asset bubble burst in the 1990s, Japan experienced a prolonged period of economic stagnation and deflation. The Bank of Japan responded by reducing interest rates to zero, later moving into negative territory and implementing large-scale quantitative easing. As a result, Japan became a major global creditor, with investors borrowing yen at low cost to invest internationally. The availability of inexpensive Japanese capital contributed to lower borrowing costs and higher asset prices worldwide. The yen carry trade became a consistent element in global finance, providing a reliable source of funding. However, this environment also introduced underlying risks, as changes in Japanese policy could influence global markets. Many participants in global markets became accustomed to the availability of low-cost yen funding. With Japan now beginning to tighten its monetary policy, global markets are reassessing their reliance on this source of capital. The period of extremely low-cost money is drawing to a close, and markets are adjusting to new conditions. Global finance is now adapting to an environment with higher funding costs. The Bank of Japan's recent rate hike, while modest in scale, represents a significant development in the global financial landscape. For many years, Japan's ultra-loose monetary policy has influenced investment strategies and currency markets around the world. By moving from negative to slightly positive interest rates, the Bank of Japan is marking the conclusion of a 25-year period of extraordinary monetary policy. This adjustment signals a new phase for both Japan and the global economy. This change is more than a technical shift. It indicates that Japan has reached the sustainable inflation it has targeted for many years, following a prolonged period of deflation and slow growth. The assumption that yen borrowing would remain consistently inexpensive is now being reconsidered, prompting traders to review established strategies. As borrowing costs are expected to increase, global investors are presented with a new set of variables, requiring careful navigation in a more complex environment. Investors now need to account for changing and potentially rising costs, which may reduce the attractiveness of the carry trade and lead to a reassessment of risk and reward in international markets. Policy decisions made in Tokyo are now as relevant as those in Washington for global markets, with the Bank of Japan's actions closely observed by policymakers and investors worldwide. The Bank of Japan is taking on a more prominent role in global liquidity, influencing capital flows and financial conditions internationally. The global financial system is evolving from one primarily influenced by the U.S. Federal Reserve to a more balanced structure, where the Bank of Japan's decisions are increasingly significant. The Bank of Japan's future policy choices will contribute to shaping global capital flows, with effects on currency values, stock markets, and international investments. The framework for investor decision-making has shifted, requiring updated strategies and a thorough understanding of changing monetary conditions. The period of consistently low-cost yen borrowing has ended, introducing a new environment that will require adaptation and careful analysis. The yen carry trade is substantial, likely in the trillions of dollars, but its exact size is difficult to determine. Participants include not only hedge funds, but also Japanese retail investors, pension funds, and insurers. Leverage is a key factor in this trade, with borrowed funds layered on top of other borrowed funds. Even modest movements in the yen can result in margin calls and the need to sell assets, which can influence markets. The carry trade has contributed to higher prices in U.S. treasuries, corporate debt, private equity, and real estate. If the trade is reduced, asset prices may adjust downward, which can lead to further selling and additional losses. This represents a risk to the broader financial system, as it is integrated into global financial networks. Major banks have significant exposures, both directly and indirectly. An abrupt reduction in the carry trade could tighten credit conditions globally, with effects on businesses and consumers. The extensive use of leverage based on low-cost yen has become a notable vulnerability in the global financial landscape. The unwinding of the carry trade will affect real economies as well as financial markets. For Japan's exporters, a stronger yen results in higher prices for goods abroad and reduced profits domestically. Emerging markets that have depended on yen-funded capital may experience capital outflows, currency depreciation, and increased borrowing costs. Countries with significant deficits could be more vulnerable to financial challenges. In the United States, a reduction in yen-funded investment may contribute to higher interest rates and slower economic growth. Higher interest rates increase borrowing costs for both the government and private companies. This process may also lead to increased market fluctuations, particularly in less liquid assets. When investors withdraw funds, liquidity can decrease, resulting in more pronounced price movements. Financial stress in one market can be transmitted to others. A currency adjustment in Tokyo has the potential to influence credit conditions in New York. The resulting effects are global and interconnected. Many economies may not be fully prepared for this shift. As Japanese interest rates increase, capital is likely to return to Japan after many years abroad. Japanese investors, including pension funds and individuals, have traditionally sought higher yields in overseas markets. Currently, domestic bonds provide stable, yen-denominated returns, without the risk of currency fluctuations. Even a modest change in investment allocation could result in significant capital moving from global markets back to Japan. This process involves selling foreign assets, converting proceeds into yen, and investing in Japanese bonds or equities. As a result, the yen would likely appreciate, which may reduce the appeal of foreign investments for Japanese investors. This dynamic could contribute to a gradual reduction in carry trade positions. Historically, Japanese capital has flowed outward to international markets. A reversal of this trend represents a notable change in global financial patterns. The effects of this shift are expected to be observed across international markets. The unwind of the yen carry trade is expected to be a measured and gradual process, rather than a sudden disruption. The Bank of Japan is likely to proceed carefully, adjusting rates in small, clearly communicated increments. Many investors take a long-term approach, gradually rebalancing portfolios as bonds reach maturity. This steady pace may slow the overall process and can lead to a sense of routine. Nonetheless, ongoing outflows are likely to put pressure on markets, gradually reducing asset values and tightening credit conditions. The process resembles a slow drain rather than a single abrupt event. However, unexpected developments, whether geopolitical, economic, or financial, could potentially influence the pace of the unwind. If market confidence is affected, the process could accelerate. Over time, the underlying resilience of the system may gradually weaken. The process is ongoing, and its effects are cumulative. It is important for global policymakers and investors to remain attentive to these developments. The Bank of Japan's recent policy shift represents a significant development in global finance. The period of a persistently weak yen appears to be ending, along with the straightforward opportunities of the carry trade. The adjustment is expected to be steady, influencing global asset prices over time. Higher borrowing costs, increased market fluctuations, and a stronger yen are likely to become standard features of the environment. Policymakers, investors, and corporations will need to consider Tokyo's decisions alongside those from Washington. The landscape is evolving, and previous assumptions may require reassessment. Opportunities for risk-free arbitrage are not permanent. As Japan's policies normalize, the global system will adapt, presenting both challenges and opportunities. While uncertainty remains, the structure of global finance is undergoing change. The world is evolving, and adaptation will be essential.